Benjamin Graham, often referred to as the father of value investing, revolutionized the way people approach stock market investments. His approach and principles continue to influence generations of investors, including his most famous disciple, Warren Buffett. Let's dive into the life of this brilliant mind, his successes, challenges, and how his groundbreaking ideas shaped modern finance. Early life, a struggle that shaped his vision. Born in 1894 in London, Benjamin Grosbaum, he later changed his surname to Graham, moved with his family to New York when he was just a year old. His early years were financially stable, but things took a sharp downturn when his father died suddenly in 1903. His family's sudden descent into poverty deeply affected him, giving him first-hand experience of financial volatility. This tough upbringing made him determined to find ways to manage risk and protect wealth, which eventually became the foundation of his investment philosophy. Despite his financial troubles, Graham excelled academically. He earned a scholarship to Columbia University, where his brilliance shone, graduating second in his class at just 20 years old. It was at Columbia that Graham first developed the analytical skills that would later become the cornerstone of his investment strategies. Wall Street beginnings and investment successes. After graduation, Graham entered the world of finance, starting as a clerk on Wall Street. Despite the mundane job title, he quickly made a name for himself with his keen eye for spotting investment opportunities. He moved up the ranks rapidly, and by the time he was in his mid-20s, he was earning more than $500,000 a year in today's dollars, an incredible sum for the time. By 1926, Graham had co-founded his own investment firm, Graham Newman Corporation. Here, he honed the strategies that would later make him famous. His method was grounded in deep research, focusing on the intrinsic value of a company rather than its current stock price. He believed in buying stocks that were undervalued by the market, ensuring a margin of safety. Graham's philosophy wasn't about getting rich quickly, but about building wealth steadily by making calculated, rational decisions. The Great Depression, humbling lessons and key insights. Like many investors of the time, Graham was blindsided by the Great Depression in 1929. The stock market crash wiped out most of his personal fortune. But instead of succumbing to despair, Graham treated this catastrophe as a learning opportunity. He dug deeper into why stocks behaved the way they did during market cycles and how they could be better analyzed and predicted. This experience not only solidified his risk-averse approach, but also emphasized the importance of diversification, patience, and discipline in investing. His failure during the Depression gave birth to the principle of the margin of safety, a cornerstone of his investment philosophy. By purchasing stocks at a price below their intrinsic value, investors could create a cushion against future uncertainty. The birth of value investing: security analysis. In 1934, Graham published Security Analysis with his colleague David Dodd. This book became the Bible of value investing, introducing the concept of intrinsic value, the idea that every investment has an inherent worth that can be measured through analysis. The book was groundbreaking and quickly became a bestseller, though it was notorious for being dense and academic in tone. Security Analysis laid out a systematic approach to evaluating a company's financial statements, advocating that investors should base decisions on hard data, not speculation or market trends. Graham's core idea was that stocks should be treated as ownership stakes in actual businesses, rather than pieces of paper to be traded based on whims. Investors should focus on a company's fundamentals, its earnings, assets, and overall financial health, rather than the market's often irrational pricing. The Intelligent Investor, a timeless masterpiece. In 1949, Graham published The Intelligent Investor, a more accessible and practical version of his earlier ideas aimed at a broader audience. The book distilled the essence of value investing into simple principles, advocating for conservative and long-term investment strategies. Graham advised investors to remain calm and level-headed, even when markets were in turmoil, a principle that he famously referred to as Mr. Market. This fictional character represents the market's emotional tendencies, with prices swinging from extreme pessimism to euphoric highs. Graham's advice? Buy when others are fearful and sell when others are greedy. Warren Buffett, who is called The Intelligent Investor, by far the best book on investing ever written, first read it at the age of 19. Buffett credits the book and Graham's teaching for shaping his investment philosophy and career. Teaching and the mentorship of Warren Buffett. Graham's time as a professor at Columbia University was as impactful as his work as an investor. His courses on investment management attracted brilliant minds, one of whom was a young Warren Buffett. Buffett admired Graham so much that he applied to work at Graham-Newman Corporation, despite being initially turned down. Buffett was persistent, offering to work for free, and eventually got the job. Graham's mentorship and influence were evident in Buffett's early investment strategies, which strictly adhered to the value investing principles taught by Graham. Graham's own investment philosophy was, well, conservative and safe. While Graham is hailed as the founder of value investing, his own portfolio was surprisingly conservative. Despite his groundbreaking ideas, Graham avoided taking excessive risks in his later years. He preferred stable, low-risk returns and diversified investments over high-stakes bets. In fact, after retiring, Graham expressed a lack of interest in amassing huge wealth, choosing to focus on teaching and writing. His conservative nature was not without merit. By sticking to his disciplined approach, Graham was able to weather financial storms and build lasting wealth, albeit not on the scale of some of his protégés like Buffett. His cautious approach also reflected his broader worldview. He believed that minimizing losses was more important than chasing high returns, a sentiment he imparted to his students. Personal life, a life of thoughtfulness, not extravagance. Though Graham was incredibly successful in his professional life, his personal life was marked by a degree of complexity. His first marriage to Estelle turned tumultuous, leading to divorce. Later in life, he married his former student, Marie-Louise. Graham was known to be intellectually curious, with a wide range of interests outside finance, including languages and philosophy. His contemplative nature extended beyond the financial world. He was deeply invested in the idea of understanding human behavior and decision-making. Graham also had a somewhat eccentric side. He once lived in California and taught himself to surf well into his 60s. Unlike many Wall Street titans, Graham was not focused on conspicuous consumption or material success. His passion lay in understanding the mechanics of markets and sharing that knowledge with others. The legacy of Benjamin Graham. Benjamin Graham passed away in 1976, but his legacy remains firmly entrenched in the world of finance. His teachings on value investing have shaped the strategies of countless investors and institutions, making him one of the most influential figures in the history of the stock market. The principles he developed are still used by some of the most successful investors in the world, and books like The Intelligent Investor continue to be bestsellers. What makes Graham's legacy so enduring is the timelessness of his ideas. In a world where market trends, technologies, and investment strategies constantly evolve, his advice to focus on fundamentals, maintain a margin of safety, and avoid speculation remains as relevant as ever. Key takeaways from Benjamin Graham's life: the margin of safety. Always buy investments at a discount to their intrinsic value to cushion against potential losses. Intrinsic value, the true worth of a stock isn't its current price, but the underlying value of the company behind it. Avoiding speculation, don't fall for market hype or try to time the market. Focus on long-term investments based on sound research. Mr. Market? The market can be irrational, and prices often swing wildly between optimism and pessimism. Wise investors stay grounded and avoid emotional decision-making. Conclusion: a lasting influence on modern finance. Benjamin Graham's life was marked by both immense success and humbling failures. From enduring financial hardship as a child to revolutionizing the field of investment, His life story is one of perseverance, intelligence, and intellectual curiosity. His ideas remain the bedrock of conservative, rational investing, and his teachings continue to guide investors toward building sustainable wealth. In the end, Benjamin Graham wasn't just trying to get rich. He was trying to make investing safer, more rational, and less speculative for everyone. And in doing so, he created a lasting legacy that continues to influence modern finance. Like and subscribe to Marty's Money for more fun and educational investment content.